Good morning, ladies and gentlemen. Will the meeting please come to order? Thank you. I would like to welcome you to the annual meeting of Group Project of Financial Ratio Analysis between two competitive companies, which is Nestle versus AFZA Global. We are webcasting and recording this morning proceedings. As today, here are 4 members that will be presenting our research finding. Now, I would like to introduce Hanis AFIQAH to start presenting the introduction of both competitive companies, followed by financial ratio analysis.
Our group has chosen the companies Nestle Malaysia Berhad and AFZA Global Berhad. Both businesses are publicly traded Sharia compliance businesses that fall within the consumer products and services tax sector in Bursa Malaysia's main market. They both come from the same industrial family as food and beverage. Since 1912, Nestle has supplied Malaysians with its premium brands and goods while upholding the perfections and integrity of halal. This is in accordance with their goal, which is to use food's potential to improve everyone's quality of life, both now and in the future. Today, Nestle Malaysia runs 6 facilities, over 5,000 employees working for it across the country, and makes more than 500 items that have received the halal certification. In 2003, AFZA Global Berhad, which consists of 3 businesses in the tin can manufacturing industries, was listed on Bursa Malaysia. The company originally produced tin cans, but as it developed over time, it entered the food and beverage market, opening up new growth opportunities. Next is liquidity ratio. There is 2 ratios in the liquidity ratio, which is quick ratio and current ratio. A liquidity ratio is a measurement which is used to indicate whether a debtor will be able to pay their short-term debt off with the cash they have readily available, or whether they will need to raise additional capital to cover the amount. Liquidity ratio, called the current ratio, assesses a company's capacity to settle short-term debts or those that are due within a year. We can observe that Nestle has a higher current ratio than AFZA Global. A greater ratio indicates that the company's asset will outweigh its liabilities. A greater ratio means the business could more than cover its current liabilities. In comparison to Nestle, AFZA Global has low current ratio. If your current ratio is low, it indicates that you may find it challenging to meet your immediate responsibilities and debts. Next is quick ratio. The quick ratio assesses a company's capacity to satisfy its short-term obligations using its most liquid asset and service as an indicator of its short-term liquidity position. You can observe that Nestle has a lower quick ratio. Greater ratio means the businesses could more than covers in current liabilities. In comparison to Nestle, AFZA Global has a higher quick ratio than Nestle. Likewise, it's not always a good idea to have a really high fast ratio.
Profitability ratio consists of 5 formula. It has a gross profit margin, operating profit margin, net profit margin, return on equity, and return on asset. Most of the company want a high profitability ratio. The higher the profitability ratio, the higher the return the company receive. Now, we continue to the comparison of profitability ratio between Nestle and AFZA Global. First, gross profit margin. We can observe that Nestle has a significantly higher gross profit margin. This suggests that Nestle retained a larger portion of its revenue after accounting for the cost of producing its good. That means Nestle is more capable to control its production costs and turn a profit from its sales. On the other hand, AFZA Global gross profit margin is 20.50%, which is lower than Nestle. This can suggest that AFZA Global must pay greater production expenses. Next is operation profit margin. We can see that Nestle has a higher operation profit margin. This implies that Nestle generates a higher percentage of operating profit from its revenue compared to AFZA Global. In comparison to Nestle, the AFZA Global's lower operation profit margin may indicate that AFZA Global has higher operational costs relative to its revenue. Following that, we have net profit margin. We can observe that Nestle has a higher net profit margin. This indicates that Nestle generates a higher percentage of net profit from its revenue compared to AFZA Global. A higher net profit margin suggests that Nestle is more efficient at generating profit after accounting for all expenses, including operating costs, interest expenses, taxes, and other non-operating expenses. On the other hand, net profit of AFZA Global is lower compared to Nestle. This could imply that AFZA Global faces higher expenses. Next, we have return on asset. We can observe that Nestle has a significantly higher return on asset. A higher ROA indicates that Nestle is more efficient at utilizing its asset to generate profits. It implies that Nestle management is effectively deploying its asset to generate higher earnings. On the other hand, ABL Global's lower ROA indicate that it generates a lower return on its asset compared to Nestle. Last, we have ROE, return on equity. We can see a substantial difference in the profitability in relation to shareholders' equity when we compare the ROE of Nestle and ABL Global. We can see that ROE of Nestle is way higher than ABL Global. That means the Nestle produce a significantly high return on its shareholder equity. This dramatically high ROE signals that Nestle efficiently use its shareholders' equity to generate income.
Next is leverage ratio. The term leverage of gearing refers to the use of borrowed capital or loans. Leverage ratio measures the level of debt or borrowing in a firm. Under leverage ratio, there is three ratio which is debt ratio, debt to equity ratio, and times interest earned ratio. First is debt ratio. Debt ratio refers to financial ratio that assesses how much leverage a business has. The ratio of total debt to total asset is the ratio. First is debt ratio. Debt ratio refers to financial ratio that assesses how much leverage a business has. The ratio of total debt to total asset is represented as a decimal or a percentage in known as debt ratio. Second, debt to equity ratio. It is calculated by dividing the total debt of a corporation by the total shareholder equity. Comparing the debt to equity ratio of Nestle, we can observe that Nestle has a lower debt to equity ratio. As less debt is shown on the balance sheet of corporation, a lower debt to equity ratio is desirable. In comparison to Nestle, ABL Global has a higher debt to equity ratio. The industry in which the company operates can affect what is deemed a high ratio. The last one is the times interest earned ratio. It measures a company's solvency by determining if it generates enough revenue to cover its debt. We can observe that Nestle has a lower time interest earned ratio. A greater ratio signifies a lower risk to lender and investor. In comparison to Nestle, ABL Global has a higher time interest earned ratio. A lower time interest ratio show that the company may not be making enough money to cover its debt.
Next, for the efficiency ratio, it measures how effectively the firm is managing its asset in generating sales. And we'll categorize into 7 ratio. Firstly, inventory turnover ratio. It indicates how quickly a company can sell its inventory and replace it with new stock. The higher the ratio, the faster the inventory is being sold. Secondly, average collection period indicates the number of days taken by a firm to collect its account receivable and reflects the company's credit policy. The lower number of days, the more efficient. Third, account receivable turnover ratio. The ability to convert its account receivable into cash at a faster rate is indicated by a shorter average collection period, which leads to better cash flow and liquidity. So the higher the rate, the more efficiency. Next is the average payable period. It measures how long a company takes to pay its account payable to its suppliers and as indicator of how effectively a company handles its debtors' repayment obligation. The shorter the number of days, the more efficient. Besides, non-current asset turnover ratio indicates efficiency in utilizing their long-term asset to generate sales. Last but not least, total asset turnover measure how well assets are being used to generate revenue. A higher total asset turnover is beneficial for a company. So based on what I'm presenting the efficiency ratio just now, it shows that Nestle is more efficiency because as we can see, Nestle has higher inventory turnover ratio of 4.12 times compared to ABL Global, which is 2.32 times. That means Nestle sells and restock its inventory more often than company ABL Global because the higher the ratio, the faster the inventory is being sold. Besides, Nestle exhibits a comparatively lower average collection period of 24.38 days, while ABL Global demonstrates a higher average collection period of 50.69 days. It shows that Nestle is relatively efficient in collecting payments from its customer compared to ABL Global. Nestle has an account receivable turnover ratio of 14.97 times, while ABL Global has an account receivable turn ratio of 7.2 times. Moreover, Nestle has an average payable period of 136.77 days. A higher average payable period indicates that a company is taking longer to pay its suppliers, which can be a sign of financial distress. However, the higher account payable turnover ratio, the more efficient for the company. Nestle pays off its account payable balance approximately 2.67 times within the specified period, while ABL Global is 8.1 times. Furthermore, Nestle shows a non-current asset turnover ratio of 3.41 times, but ABL Global is 2.11 times. It shows that Nestle is efficiently utilizing its long-term asset. In addition, Nestle demonstrates a total asset turnover ratio of 1.87, while ABL Global is 0.76. So from the above figure, we can conclude that Nestle company is utilizing its asset more efficiently than its competitor.
Okay, next I will be presenting to you the last ratio, which is market ratio. Okay, market ratio can also be called as investors ratio. It evaluates investors' perception and judgment of a company's growth potential. Okay, now we will introduce you 5 ratios under market ratios. First, we have earnings per share. This is the most generally used ratio that concerns common stock and also indicates the profit earned per unit of issued shares by firms. A higher value indicates a higher profit earned. Okay, next, dividend per share. Dividend per share indicates the amount of dividend received by ordinary shareholders for each unit of ordinary shares held. Besides, the company may evaluate their financial performance by calculating this ratio. Okay, then dividend payout ratio. This ratio represents the percentage of earnings issued as dividends to shareholders. Okay, next, price earnings share. It compares the current market price with the amount of a firm's earnings to establish whether the stock is overvalued or undervalued. Okay, the last one is dividend yield. It compares the dividend per share received by the shareholders with the current market price. The dividend yield measures how much income has been received relative to the share price. Okay, as you can see now, we have made comparisons between these two companies, which is, as you can see, the earnings per share for Nestle is higher than Global. Hence, Nestle has a better preference for existing shareholders and potential investors due to its higher EPS rather than Global, which is RM2 and 65 cents over 11 cents. Okay, next, dividend per share. Dividend per share for Nestle is higher than the Global. So, Nestle will pay higher up to RM2.62 dividends per share to its existing ordinary shareholders, whereas Global only pays 4 cents for ordinary shareholders. Then, we also have dividend payout ratio. As you can see, dividend payout ratio for Nestle is extremely higher than the Global Berhad. The Nestle Group distributes 99% of its revenues as dividends and thereby reserves only 1% of the surplus for reinvestment, expansion, and other uses. And this might attract more investors as they probably will get a higher return or huge return. Nevertheless, according to Global's calculation, they get 37% for dividends and remain 63% for reinvestment, expansion, and other uses. And this will make company might have the potential of improve of its financial performance. Okay, next, price earning ratio. Okay, as you can see, price earning ratio for Nestle is higher than Global, which are 52.92 times over 12.44 times. Okay, since the price earnings ratio for Nestle is higher, then it might indicate that the company's stock is overvalued. The last one is yield, dividend yield. A higher dividend is more attractive, while a lower yield can make a stock seem less competitive relative to its industry. And as you can see, Nestle has lower dividend yield than the Global Berhad.
Next, we move on to the next agenda by utilizing SWOT analysis. The first one, I'll present to you the strengths of both of these companies. Nestle is more efficient. Why I say so? Because in terms of inventory turnover and accounts receivable turnover, Nestle has impressive asset turnover ratio. This indicates efficient inventory management, prompt receivable collection, and successful asset management. Besides, Nestle has a strong brand reputation. Nestle's products are well known by consumers. This allows Nestle to command premium prices for its product, which contributes to its high net profit margin. Moreover, Nestle is constantly developing new products and new ways to market its products. Furthermore, Nestle has higher profitability, ROE, due to its efficient in managing its asset. The higher the ROE, the better the return for the shareholders. However, Global still have their own strength, of which the first one is the company efficiently managing its payable. Paying suppliers promptly can foster stronger relationship. Suppliers are more likely to provide favorable terms, discount, so this can lead to improved supplier support and reliability. Besides, Global has proven that the company reached the higher quick ratio and current ratio, which indicates that the company has sufficient amount of liquid asset to meet its short-term obligation. The higher ratio make it easier for a company to pay creditors on time.
Now, I will be explaining the weaknesses for both companies they are facing. For Nestle, they have low liquid asset. Company short-term liquidity against its short-term obligation is lower compared to Global. They are also having a longer payable term. The company use longer period to pay off their debts to the supplier, which means they must withdraw more money. They also have a higher debt ratio, which means the company might not be able to produce enough money to repay its debts. Now we move to Global. The weaknesses they face is low efficiency. The company has low inventory turnover ratio, longer average collection period, fewer account receivable ratio, smaller total and non-current asset turnover ratio. And then from profitability ratio we calculate, we can conclude that they have less profitability. The company has overall lower ability to generate earnings relative to its revenue, operating costs, asset and shareholders' equity compared to Nestle. Last, they also have a low time interest earned. The lower the time interest earned, the fewer earnings are available to meet interest obligation. Failing to meet this obligation could increase the possibility for a company to fall into bankruptcy.
For the Nestle, which is three opportunities, which is venturing small food startup. Nestle has a fantastic opportunity to grow the number of small food startup under its popular brand name. Nestle can also collaborate with the new startup to promote its brand name. Next one is partnership. The company has a tremendous chance to boost its sales and profitability by performing strategic partnership with other household names in the food and beverage industry. The last one is alternative. Nestle has already come under fire for misrepresenting the nutritional effects on its labeling. As a result, there is room for improvement by providing reliable information and appropriate labeling its item. For the AFZA Global, we take two opportunities. One of them is further develop the business. The debt ratio of the AFZA Global is low. Investor will be more interested in low debt ratio, since a low debt ratio indicates that the business is stable and has a solid financial sheet. Next is increasing consumer demand. The increase its market share, AFZA Global Malaysia can pinpoint and satisfy particular consumer wants and preference, provide a creative solution, and fortify its market position.
Okay, for the last SWOT analysis element, we have threats. Okay, first we will be looking at the threats for Nestle. First, competitive rivalry among the well-known. Okay, as we know, Nestle is a very well-known company, so it needs to compete more in many terms, such as brand recognition, taste, price, quality, and advertisement to anticipate and respond to consumer demand. Hence, the presence of this competition could lead to market share erosion and pressure on pricing and profitability. Okay, second, health and safety concerns. These concerns, if we have any incidents or controversies of these concerns, it will have a severe impact on Nestle's reputation and consumers' trust. Hence, they will mark loss of sales and damage to the brand image. Okay, then we go to the threats for AFZA Global Berhad. First, we got strong competition, which is AFZA Global will face challenges in chasing the eyes of customers, because AFZA Global is strangely known by many people, and they will have a hard time to keep raising and maintaining their good performance. Okay, next, low preferences of investors, as they offers low returns to the investors due to its low dividend payout ratio. So investors could expect that they could not survive in the industry, and even worse, they could not give a good return to investor as the investor want.
In order to determine the future general financial condition of both companies, debt-to-equity ratio and operating profit margin are crucial parts in predicting a company's financial stability. By overview of these two ratios, Nestle has a better standing with a low debt-to-equity ratio and a high operating profit margin, and it's considered safe enough. As we all know, the debt-to-equity ratio is the leverage ratio that can be useful in determining company's economic health and whether an investment is worthwhile. Due to inherent risk in debt, investors tend to favor companies with a lower debt-to-equity ratio. Furthermore, operating profit margin is one of the ratios used by investors and analysts when evaluating a company profitability. Operating margin is considered a good indicator of how efficiently a company it is. Overall, based on our point of view, AFZA Global is in a riskier financial position compared to Nestle. The values of these leverage and profitability ratio, which aid in forecasting financial conditions, should not be overlooked. As an investor, it is safer to invest money into companies that have a better leverage and high profitability ratio.
Both businesses have the potential to expand even further and improve their efficiency in terms of producing future returns. Given that Nestle has a longer average payable terms, which could reduce the company's ability to generate profit, they can make use of the incentive of improving cash flow management and strategically prioritizing payments. In contrast, AFZA Global has a lower rate of inventory stock to be sold or replaced, slower period to receive payments owed by their clients, and less efficiency in using their resources in generating sales. Therefore, we provide some suggestion to counter this efficiency, which is adjust the way it currently order good if overstocking, adopt a stricter collection policy, and maximizing asset utilization.
Okay, how do you suggest to the board of directors on which companies is worth to be invested by the company? Okay, first of all, we will make a decision on which company is more fortunate and worthwhile for someone to invest in. Then, we will foresee the company that promises a higher return and guarantees a long-term investment. And we will make sure that the company we have chosen has a good financial performance. Okay, here we have made comparison between the Able Global Berhad and Nestle Malaysia. First, the Able Global Berhad. Since the Able Global Berhad's dividend payout ratio is lower, then it has higher likelihood of future corporate growth. This make it has chances of reinvestment and expansion of the company. Then we go to Nestle. Nestle offers higher earnings per share and dividend per share, and this will make Nestle has higher potential dividend paid to shareholders. Other than that, Nestle also has extremely higher dividend payout ratio compared to Able Global, so it will catch more eyes of investors to keep invest on their company. Then this will retain their investors' preferences. So we have made decision that Nestle is worthy to be invested by the company rather than the Able Global Berhad.